So I'm taking you back to the 70s. And what I'm going to show you is virtually every time that preceding a recession, a correction in the economy, that the pundits, whether it's the Federal Reserve chairman or other economists, said over and over again, we expect a soft landing. So here we are in 1973. What was going on in 73? Well, Nixon was dealing with Watergate at that time, if that recalls anything for you. I was in high school, and we went into a heavy recession, not a soft landing at all, heavy recession in going into 74. 78, again, soft landing expected. 78, again, recession. 1980, we had back-to-back in 80 and 81, heavy recessions, Volcker at the helm, 20% funds Fed rate to beat down inflation. Soft landing expected, that's what they said. 89, once again, as we blew into 1990 into a recession. Going to 2000, once again, soft landing in sight for the economy, rate cut next, right? And then the one that preceding what we're dealing with right now is Bernanke back in 2007. Once again, he's expecting a soft landing. He saw no issues at all with all the mortgage-backed securities and subprime lending, no issue at all, and blown away. And what do we have going on here today? I'll stop the share and come back to full screen. Just this last week, Wall Street Journal, Federal Chairman Powell states, no issue. Recession, we're beyond it. Other markets, housing has bottomed out. It's all good. We're all in the clear. Charge ahead. And you see the same exuberance in the marketplace. I have seen this over and over again. And I'm just telling you, when there is a saturation of opinion like this, that's the time to look the other way 100%. Now, I am telling you my bias. You don't have to believe me what I'm saying. You can have your own, but I'm just telling you, I think we are on the, we've crossed over the tipping line and we're starting to head down. And I think the next several quarters, we could see some heavy issues. Let me just give you a few stats. Weekly retail sales are plummeting. I mean, plummeting. Industrial production plummeting right now. The leading economic indicators for the last 15 months, all heading down. Every time we've had that, we've had a heavy recession afterwards. Credit card accounts, spiking up, a parabolic upshoot in just the last number of months. We have corporate bankruptcies are way up on the rise right now. You know what SLUICE is? The Federal Reserve reports the senior loan officers across the banking sector, all tightening standards for all kinds of lending right now, commercial, personal, credit cards, all tightening. Again, I'm not putting all these graphs up here, but just the spike up for tightening is amazing to see. So that's all commercial and personal lending. Oh, multifamily starts right now exceeding the number of units for sale. How is that going to pan out next year? You had a recession to overindulge inventory. Just beware. The CNN, they have this fear and greed scale. So over here is high level of extreme fear, and over on this side, extreme greed. Where do you think? And a year ago it was neutral. Where do you think it is today? It's extreme greed. And this is reliable. I mean, I'm not big on CNN for general, but this is a reliable indicator. Extreme greed. What does Warren Buffett say? Be fearful when people are greedy and greedy when people are fearful. Well, it's greed time right now, folks. Really a time when we've been talking about it. Take your foot off the pedal. Take your foot off the pedal. Don't be running for the high yield stuff that we've been used to in years and quarters past. And we've been talking about it. So I'm just reiterating what we've been saying, but I'm just giving you data here. Housing affordability. We know that, a little over a year ago, you could get a homeowner mortgage, first lien mortgage at under 3%, 7.7 today. That number is not going to go down anytime soon. I think as much as we have good people, everybody's going to be incentivized to do what? To state an opinion that's more in favor for what they do. It is human behavior. It's not bad. It's not fraud. It's none of that. It's just we have to also always understand why someone's saying something. And then you have to take the differentiating points and you have to decide for yourself, what do you think is right? You have to decide for yourself, what do you think is right, but take the different opinions. Used car prices are falling by the most since the start of the pandemic. So, you know, car prices have been up, and now they're falling. Now, you might say, well, gee, David, we flew somewhere in the last week or two, and the airports are flooded. Yes, they are. They are just stacked to the gills. And you go to tourist resorts, vacations, stacked to the gills. You go out in Dallas on almost any night of the week, but you pick, you know, towards the end of the week, Thursday, Friday, Saturday. I mean, it's standing room only. You got to have reservations to any of the decent places. So what's going on, right? What is going on? I think it's a couple of things. It's still the lag effect of the rise of interest rates still have to roll over, and that's at least 6 months, 9 months, 12 months to have the full effect. And I think, like anything the Federal Reserve tries to do, they're steering a Titanic through the Panama Canal. They spin it really hard, and it takes a while to turn that ship. But boy, if they go too hard one way, you can't just spin it back the other way. And I think that's what they're doing. I think they're crashing this thing because they just don't have a pulse. They look at not leading indicators so much as they look at lagging indicators, like rents. Well, rent's a lagging indicator. People sign leases for a year at least. And so for those rents to actually show that they're coming down, which they are coming down, it's just that people that signed up for a lease a year ago, well, they're still stuck at that lease until they come to renewal. But rents are coming down. Now, not precipitously dropping, but it's affordability. So when we go, assuming we go into a hard recession, there's layoffs, and middle America, who a lot of times are maybe our patients, certainly the retail customers, people who rent apartments or houses, when they can't make ends meet, what are they going to do? I mean, and we have all this inventory, at least multifamilies coming on big time. I know we have a housing shortage in inventory. That's helping keep housing up, and that's good for any of us who own houses. That's a good thing, but I still think we're going to see some offsets there because there's only so much that people can afford. And when they start running out of all the money that was spun out by the fiscal policies of Congress and the Federal Reserve just increasing their balance sheet by trillions of dollars, that money is like a pig in a python. It has to work its way through the system. It wasn't an efficient layout of money. A lot of it went to us. And maybe that was in businesses with PPP loans or the ERC BS that's still pumping billions of dollars in the economy. That's all highly inflationary, highly inflationary. What the Federal Reserve had to do back in March when we had a Signature Bank, a First Republic, they had to come back and flood the market with more liquidity. I mean, that's inflationary. The Inflation Reduction Act, it's the Inflation Expansion Act. It's all inflationary. So they talk the game of, well, inflation's coming down, but you know, they spin the numbers and they use lagging indicators like unemployment. Well, it's still tight right now, but it's going to revert. It has to revert. It always does. We've just had a government that's out of control, that's kicked the can down so far down the road, but they've got no place to go. And I think we're really at the end of what they can do. And we've got a split Congress. So the handouts that we've seen in the past, they're just not going to happen. The rubber meets the road. And I'm just telling you all from a business standpoint, I'd be prepping your team, your team that serves so well that you want to keep on. Start prepping them, because you don't want them to go bad, meaning they start running to cash flow problems, because then it becomes a problem for you, does it not? Yes. So I think you need to have some discussions. You're not giving them financial advice per se, but you're just trying to tell them to, cut out the excesses. It's a message that no one wants to hear because everybody's used to all this money they've had in the last several years, even not even working. It's hard to change human behavior, but this is going to get tough, I believe. Now, if you're positioned well with your business, you've got good margins, you're not overloaded with debt yourself, you've kept some money on the sidelines, I think there's going to be some huge opportunities coming, not in two months, 2 quarters, but I think 2024, 2025, huge opportunities are coming. But everybody wants to know, well, where can I get the latest hot deal? As you know, and I've said it, and I am just not a fan of some of the syndications I'm seeing. It's the same old, same old. Oh, it worked 3 years ago, no problem at all. But it's the same old, same old. I said, I personally wouldn't touch it. What's the debt structure? Well, it's a typical 3 years with a rate cap, and then we have to refi. What's your assumption on a refi? 5%. I go, how do you know? Well, because rates have to come down. I don't buy it. I don't buy that rates have to come down at all. Who says rates get to come down? Does the Federal Reserve manage the long-term 10-year bond rate, which is based on what the mortgage interest rates and commercial lending? No, Federal Reserve has no control over that whatsoever. It's the marketplace. The Federal Reserve tries to manage the short term, but they have to follow the curve. So I don't believe what anybody says that, well, we have to come down. No, it doesn't have to come down at all. There's no reason to that. So I looked at another syndication this week from somebody, not part of our Freedom Founders group, but somebody who has actually spoken at a meeting some years ago on some areas that he's very good. Well, for the first time ever, this gentleman, who's smart in certain areas of real estate, he's capital raising for the first time with a co-sponsor, and he tags me, right? Texts me, hey, David, you want to look at this? I'm really excited about this deal. Sure. He goes, you want to get on a call? Nope, I don't want to get on a call. Send me your operating agreement. I don't want to get on a call with anybody till I get to read the documents. And I read it, and it was horrific. Now, he didn't write it. He's just promoting it, but it was horrific. Wouldn't touch it with a 10-foot pole, but this is late cycle BS. If you haven't pivoted your model to the market conditions to today, you may not be relevant. That's what I want to give you tonight.